Welcome to Enlightened Wealth Strategies, the podcast where insight and knowledge meet opportunity. Please join us as we navigate the world of finance, discovering actionable strategies to help you achieve your personal financial goals.
With decades of combined experience, we're here to shed light on the topics that matter most to your financial well-being. Whether you're accumulating, preserving, or distributing your wealth, this is the place for you.
Now let's dive in and start your journey to financial enlightenment.
Well, hello there, James.
What's your name again?
I forget.
Jim.
I think it's Jim. There you go.
It's an easy name to remember.
So today we have a special guest, and who might that be?
Steve Blackwell of Invito.
Nice. Steve, are you with us? There you are. Hi, Steve.
How are you all today? Thanks for having me on.
We're doing well. Thank you. How are you today?
Fantastic. I am in a hotel in Denver going to an event tonight, but happy to jump on the podcast and talk some strategies.
Excellent. So glad you can join us. And we just had a conversation about Roth IRAs and Roth conversions. And I know you and I have spoken in the past. We've actually spoken to some of my clients who are considering going through this process. And one way in which to minimize, if not completely, perhaps eliminate, that's the ideal strategy, to eliminate their tax liability related to a Roth conversion is the use of your investment fund. Is that correct?
That's correct. Yeah, we run essentially what's called the drilling fund. So we're invested into the acquisition of what's called working interest into brand new wells, and there are significant tax benefits to that. So yes, this is definitely, we've seen a number of advisors that we work with use this strategy in conjunction doing a Roth conversion and using our fund to offset, either eliminate in some cases or just reduce the tax bill associated with that conversion.
Okay, that's great. Now, before we go into that, this is the crux of what we really would like to discuss. But I think it's important for our listeners to better understand what it is that you are doing with your fund, because it's kind of unique, and I'd love for everyone to hear how you set up this fund and really what it does, other than limit individuals' tax liability, which is very important. But I think it's really important for them to understand what the underlying investment and your philosophy and approach is.
Yeah, great. So, I mean, if you want to invest into the oil and gas sector, you can obviously invest into publicly traded E&Ps, invest into an EFT, something along that nature. But if you invest directly into oil and gas, you can either acquire what's called working interest, which is essentially equity in wells, or you can acquire what's called royalty interest, which is what comes alongside. So at every well, there's a working interest owner, and the working interest owner pays their proportionate share of the capex to drill the well. They pay their proportionate share of the monthly operating expenses, and then they receive their proportionate share of the monthly revenue. The royalty owners don't pay capex, they don't pay lease operating expenses, and they get paid first. And there's typically a 10 to 25% royalty on every well that's drilled. But the only one that offers a big tax deduction up front is when you invest into working interest, not in wells that are already producing, because you can buy cash flowing wells. But if you invest into working interest of wells that have not been drilled yet, there's a big tax advantage to that. And so what we do specifically, my background is an executive running upstream oil and gas operating companies where we were the operators of the wells. And what we do today is, as a fund manager, we are primarily acquiring small pieces of working interest. And when I say small, let's say anywhere from 0.5% to 1, 2, 3, 4, 5%. It could be as much as 10 or 20%, but typically we're in that 5% and below working interest range on wells being drilled by other companies. So what's called non-op working interest. And we're targeting the wells that are being drilled by the larger E&P companies in the United States, all onshore, and mostly in the oil basins. And there's really 6 major oil basins in the United States. And then we're targeting what's called their tier 1 acreage, which is their most de-risked acreage positions. So that's what we do. And we aggregate that and put it into a fund.
That's fascinating. Jim, do you have any questions?
I guess a little better understanding. I was under the impression, or at least from what I read, that we are limited on how many wells can be opened or drilled at this time. Is there still that many wells being opened?
Oh yeah. So, I mean, look, you're asking the political side of the question, right?
Exactly.
So obviously with the new administration coming in, but here's a fact that blows everybody away when I tell them this. So the United States in 2023 exceeded 13 million barrels a day of oil production. We're not talking natural gas, of oil production in 2023, which is the largest production by a country in the world ever.
Really?
And that happened under the Biden administration. So
go figure, right?
Yeah, right. So what I try to tell people is when it comes to politics and energy, especially if it's a politician speaking, most of the time you should just ignore it. So the reality of it is the United States consumes over 20 million barrels of oil a day. The world consumes over 102 million barrels of oil a day. And the United States produces, roughly 13 million barrels a day, and that's the largest in the world. And so, the reality of it is everybody's life depends upon oil, whether they like it or not. It's not going away anytime soon. Now, the Biden administration was unfriendly in terms of regulation. There's no doubt about it. They definitely increased costs from a regulatory and compliance standpoint. The biggest way that the federal government has control is on federal land, so federal onshore and offshore lands, and they definitely restricted that. I think within the first week of the Biden administration, he put a moratorium on leases, and of course, he backed off of that about 90 days into his administration, and he has definitely just last week, right? He put some. I don't know if it was an executive. I think it was an executive order literally last week.
Right.
He put an executive order in place on some offshore, trying to restrict offshore drilling again. And so, that part of it they can have an effect on. But the reality of it is there's still the majority of the drilling locations in the United States are not federal lands. They're private lands or state lands. And so, the United States is the leader in the world in terms of oil production, which most people would find hard to believe under the current administration, which would have happened either way, right? Didn't matter if it was Trump if Trump would have stayed in power or in the administration, it would have happened either way. Because at the end of the day, the government doesn't control the industry, and they need it.
So Steve, to that point, what you mentioned, you gave some statistics there. So 13 million is barrels a day is produced, and we're consuming 20 million. So obviously there's a shortage domestically. So we have to go out and import that, correct?
Sure.
And now, what's your outlook moving forward with not only the new administration, but just in general with regard to the industry, for maybe covering that shortage? And in general, with regard to the administration, so what do you think we might be seeing over 2025 and even into 2026?
I mean, look, we've always been importing oil. Well, for the long foreseeable future, we're going to be importing oil, not only because we don't have as much as we need, but also most people don't understand that the refineries in the United States need what's called a blend of crude. Most of the refiners are old, and they need what's called heavy crude. Most of the crude oil produced in the United States is called light sweet crude. And so our refineries are not equipped to only produce and refine light sweet crude. So we always have to move in a blend. And some of that comes from Canada, some of that comes from other parts of the world. So we're always going to be importing some oil, at least in the next, for the foreseeable 5 to 10 years. Now, maybe that changes. But in terms of, as an asset manager, right? Because, your mindset shifts from you're an executive running an upstream oil and gas company into an asset manager now running a fund. Obviously, commodity price is one of the biggest KPIs or the biggest factors that determines the performance of your fund. And so when we're looking at oil specifically, right, I've been in this business a while. And so our mindset is that oil trades in this normal kind of supply and demand world of $60 to $80 a barrel. But then we broaden that out and say, okay, really, we brought it out to the downside, really down to around $50 a barrel. And when we're underwriting assets, we're always looking to see how do we perform and can we perform at around $60 a barrel? And what would we look like if we're around $50? And then what is our break even? And so really what that means is from an underwriting standpoint, the upside is great. Like $70 and above is just great. It's great. It's gravy. Returns are going to be, everybody's going to be very happy. But I can't predict that that's going to happen. A lot of people are predicting that's going to happen this year, but you could easily see maybe we trade in the low 60s this year. And so how do you perform when you're underwriting an asset is at the lower end of the curve is really how we try to manage risk from a commodity price standpoint. And so what I say to that is my expectations are the same as they've always been in terms of how do I manage and underwrite assets. I want to see how we can perform in that $60 a barrel range. What do we look like around in the 50s and where's our break even? Because if I look at the last 20 years, and if I look at a WTI chart over the last 20 years, we have had very little time where we were below $50 a barrel. And so that's kind of how we approach it.
Okay. Jim?
I guess going back to a Roth conversion, if we get involved in that, how does your fund take advantage, or how does the participant who wants to get involved with your fund, how does that help them with the conversion?
Yeah, so the big tax benefit to participating in drilling wells directly is what's called the IDC deduction, which stands for intangible drilling cost. So when you drill a well, there's two main types of costs. They're called intangible drilling costs and tangible drilling costs. Intangible is literally anything that goes into the ground to drill a well that has no salvage value when the well is done producing. And that's typically makes up 75 to 85% of the total cost of a well. So the IDC deduction, which is 263C of the code, essentially says, and it's basically depreciation, but it's called the intangible drilling cost deduction. It allows you to take 100% of those IDCs and write them off in the year of investment. So let's just make this really easy. Let's say that an investor puts in $100,000 and say into our fund. And let's take last year, 2023. Our IDCs for last year were 83%. So on the K1 that came out on March 15th, and we actually get our K1s out on time, that good loss on that K1, which would show up on line 13, is an $83,000 loss. Okay. So there's the big loss that you could, but the home run really here is this is a passive investment. This is 100% a passive investment, but there's an exception in the passive active rules for specifically working interest investments that allows you to take that loss and offset ordinary income. And so surprisingly, most people even in the oil patch don't even know how this works. And so that's the home run, right? So this is a complete passive investment, but the loss is such that you can offset active income. So obviously that could be applicable in a lot of ways. You guys are planners. I'm sure you can think of a lot of ways that would be beneficial to high income earners, especially on the W-2 side. But so you make that Roth conversion, right? You get that big tax bill, that's ordinary income. Make an oil and gas investment, as long as it's structured the right way, you can take that loss and either offset it, reduce it, or in some cases, eliminate the entire liability that comes from that Roth conversion. And then now you have an investment on top of that, because it is an investment. First and foremost, it's an investment. Secondly, it's a tax strategy. Is the way I look at it.
Steve, I'm glad you said that, because that's really what I wanted to emphasize, is the fact that it's an investment first and foremost. Yeah, we like income tax strategies to help our clients minimize their tax liability where possible. But I also wanted to point out, too, is just what you really said, and I want to emphasize it a little bit, is that it's an investment, and I've seen in cases as a CPA where clients invest in a fund like this. They're not necessarily doing an IRA and making a Roth IRA conversion. They're just investing in it because it's number one of interest. They like the investment, and yeah, they get some tax benefits out of it. And they could be W-2 earners only, where the predominance of their income and the creation of their wealth or accumulation thereof. Maybe they work for a company, they're a corporate executive, and they're offsetting the ordinary income from with the, as you described, the IDCs and the so from the investment within the fund. So it's beneficial from that standpoint as well, in and of itself, rather than just only looking at it as we are at the moment, predominantly the fact that we're taking retirement plans and converting to a Roth IRA where it might make sense for certain clients. So yeah, I do want to make sure that we're emphasizing the fact that it's an excellent investment as well. So to that point, I did want to also maybe you could share with us too. You mentioned that there's a number of there's only a handful of basins within the U.S. that exist, and so are you in? Is your fund in all of them, or just two or three, or one of them? Just curious.
Yeah. So we're the major basins that we focus on from an oil standpoint are the Permian Basin, which is in Texas, and in Oklahoma or New Mexico, which most people are familiar with. Then you have what's called the Anadarko Basin in Oklahoma, the Permian or the Powder River in Wyoming, and then the Bakken Shale up in North Dakota, the DJ Basin in Colorado, and the Eagle Ford Shale in southern Texas. So there are other oil plays around the country, but those are the major ones in the United States. So as a fund who's acquiring non-op working positions, we are agnostic to the basin, meaning we're not locked into a certain basin. So we probably underwrite. So we have the strategy of non-op strategy we've been working on for at least a couple of years. One of the biggest challenges to it is the ability to generate enough deals to have you have to have a lot of deal flow to consistently be able to underwrite enough transactions to then find ones that fit and meet the KPI metrics from a financial standpoint, and then go chase those deals down. So we probably underwrite 40, 50 deals a month. Believe it or not, maybe 10 to 15% of those pass the financial metrics. And then from there, we move them to an acquisition team to try. Just because we pass them doesn't mean we can acquire them. So it's a lot of work, an extreme amount of data. What I just mentioned is a ton of data that we're moving, analyzing, and then there's the whole acquisition side of it, which is a lot of work as well. So what it allows us to do is not get pegged into one basin or be what I call asset specific or asset bias. In other words, if I have a project, right, and let's say it's a 20 well project, 15 well project, whatever it may be, 10 well project, and if I'm pitching that project and I've already put all my capital into acquiring that position, well, of course, I'm going to pitch that asset and put it in the most favorable light possible, because that's what I have to raise money for. And so we feel like the ability to generate 40, 50 deals a month, be very disciplined on the metrics, and not get pigeonholed into one basin is a benefit to us in terms of managing risk. And so those are the major basins that we focus on.
So you're well diversified within the energy field.
Yeah, we have diversification in terms of basin, and also in terms of operator, and a little bit of commodity as well. We don't participate today in what's called pure gas plays, pure gas wells, which would be like the Northeast, the Marcellus Shale, or some of the Haynesville stuff in East Texas. But in the Anadarko Basin, you do have, and some of the Permian, you do have, most oil wells, just as a side note, produce gas as well. Most gas wells don't produce oil. So you always have some associated gas that's being produced when you are drilling an oil well for the most part. And so that does give you a little bit of commodity diversification as well.
Okay. Jim?
Fascinating. If an investor wanted to participate, what requirements would be necessary in order to participate in your fund?
Yeah, I mean, think for us, we're a 506c offering. So you do have to be accredited, and you do have to verify that accreditation. So beyond that, kind of back to James, your point that this is an investment. What I always tell people is, when you're looking at oil and gas, and I'm not a financial advisor, but this is what I say to people. I'm like, look, this decision should be made holistically as part of your overall planning process, right? So it's not only the risk that comes of the asset class of oil and gas, it's an alternative asset. So what's your overall allocation to alts, right? And then where would this fit into that? How does that affect your liquidity? Because most alts are illiquid. This one's definitely illiquid. If you're doing it as part of a Roth conversion strategy, that's fantastic. But again, you have to have liquidity in unqualified accounts, right? And then how much liquidity do you have there, and what is that allocated to? So it's a much bigger picture when from the macro standpoint, and then drilling it down. You have to be accredited. You certainly have to have liquidity. That's one of the points we hammer home. This is an illiquid investment, and it's at least a 5-year hold. And so if you have any need for this in terms of liquidity in any near future, then I would suggest you don't do it. But if you're an accredited investor, you have, a good plan in place, you have liquidity, you have the ability to allocate some of this to oil and gas and do it alongside a Roth. Man, it's a fantastic strategy, and so it's one that I'm personally doing myself. We'll actually start doing in 2025. I'm not going to do it all at once because I don't have the liquidity to do it all at once, but I'll do what's called chunking, I guess, is a little bit each year.
Yeah. We to your point or points, you made multiple points there. Yeah, as advisors, we really do want to sit down and number one, determine if that individual that is our client is qualified to be in a fund like this. Number one. Number two, that it resonates with them. So you and I will have a conversation with our clients to see if they want to do it. If they like it, great. We also do look at the overall percentage of their investment allocation that is going towards the alternative space. And then, of course, this is another diversification within that space. So we have to look at a lot of different details and do long range planning. And yeah, they of course are going to understand the fact that it's illiquid, and that hey, you're not going to be able to access this for some period of time. And we're not going to put somebody in it that they would need those funds. So they'll fully understand that.
That 5-year timeline though makes all the sense for the Roth conversion.
Exactly, yeah. Because now, as Steve pointed out, he's doing it himself, and he's smart enough to know what we talked about is that we do multi-year tax projections so that we don't bump ourselves up into the next tax bracket.
Exactly.
Or we minimize it as much as we possibly can, and we try to find that sweet spot where they're making less income. Be it if they're in retirement or approaching retirement, maybe they're working part-time, maybe, they're not making the large W-2 income that they were before. And they're not, as we talked about before, they're not earning Social Security benefits. They don't have to take RMDs yet. So this is the time in which they do the conversion. And then when they do the conversion, we utilize an investment strategy that like this, that helps to offset the tax liability with the losses, so to speak, that this type of oil and gas fund is offering.
Jack, my question to you had mentioned that you had been on the phone a couple times with James and maybe one or two of his clients. Do you do that for all advisors, or is it just because you know James?
He likes me.
I know he likes you.
Well, I do like James, but what I would say to that is that I offer that to anybody. What I would say with the advisors that I work with, the spectrum ranges, right? I mean, some guys, I never even meet their clients. So I never talk to them. And then other times I offer to get on the phone and alongside the advisor, walk, which is my preference, by the way, because look, oil and gas is a different animal, right? And it's
Absolutely.
a very technical business. So, I prefer that people have a good understanding of what they're getting into. And, at least gives me an opportunity to articulate, what I would say about oil and gas is, look, it's very important if you're looking at oil and gas that whoever you're speaking to can articulate to you the strategy of how they're managing risk, because there are lots of investment types or drilling opportunities in oil and gas where you can literally lose your money. You can lose all your money, or you can get very little back. And that is what you, from a retail standpoint, my personal opinion is that you want to avoid. And, partnering with IRAs, of course, that's the number one message you'll get from advisors is, don't lose my client's money. Maybe if it doesn't perform as well, that conversation can be had. Is not as painful, but there are lots of drilling opportunities out there that are normal from a risk standpoint from an oil and gas company to take. Every oil and gas company always has to have a part of their CapEx that's allocated towards what would be called more exploratory projects, because they're always trying to build their inventory. It's kind of broken down into tier 3, 2, and 1 in the oil and gas spectrum. And you're taking your tier 3, trying to prove it up, move it to tier 2, move it up to tier 1, and tier 1 is where they drive the majority of their cash flow. And so that's the part I would say that is challenging, can be challenging from an advisor and investor standpoint, is to make sure that you are not getting into, look, if you get into tier 3 stuff, that's fine. And you just need to understand that that's what you're getting into. And sometimes the upside is bigger, but there's a much greater downside to that. And so, don't get lured in by tax and then lose your investment. That doesn't really work out long term, is what I try to tell people.
Can't agree more with you.
Steve, one other question for you. So I know that you and I have already spoken to some people, but if we were to, I'd like to just maybe outline the mechanics of how this would work, and really kind of, again, emphasizing my approach anyway, is that I'm the type of advisor that does want to have my clients not only have a conversation with me, but have a conversation with us, myself and the client, with you, because then you have the opportunity to explain to them, as you said, articulate to them exactly what the fund is, how it operates, how it works. And then the client has an opportunity to ask questions, and they know the people behind the fund. Some advisors, I guess, are comfortable doing that. I'm not necessarily of that ilk. But so let's just say we go through an example whereby you and I speak to one of my clients. They would want to do this. What would be the timeline that we would go through, since now we're here in the new year? It's January. So what would be the timeline? So if we have a conversation with somebody in the next couple of weeks, what are we looking at through chronologically between now and the end of the year? And what should we expect, and what should they expect as a client in getting into the fund, and what they will get out of the fund in a 1-year time horizon, and then even beyond that as well?
Yeah. So for us, we typically have 2 funds a year. So our first fund will open in the second quarter, probably April. Mm-hmm. So as it stands today, our 2024 fund closed on December 31st. We'll open a new fund, what we call it the Opportunity Fund, in the second quarter. And then we'll open up our annual drilling fund in probably August. And so, the process really is, these initial conversations, getting information, getting them access to the data room, which has all of the information about our fund, including, the private placement memorandum, partnership agreement, subdocs, and then some presentations on, most importantly, what I do with advisors and clients is walk through what's called an executive summary. And inside that executive summary, I'm kind of talking about the things that we talked about. How do you invest in oil and gas? How do you do that? How do we manage risk? But the biggest thing that I go over at the end of the deck is the expectations, right? So on a drilling fund for us, and not all drilling funds are the same, but for Invito Energy Partners, the expectation that we put for people is, if you invest in the year you make the investment, so let's talk about 2025, the difference between the Opportunity Fund in the second quarter, by the way, and then the Drillco Fund that will open, that'll go through the end of the year, is that second quarter fund will be smaller, but it also will target a higher IDC for 2025. And so, just as a side note, because we didn't get into the tangible portions of the costs, the tangible remaining costs, so that if 75 to 85% is IDCs, the remaining 15 to 25% is what's called tangible costs. Typically, you amortize those over a 5-year period, but you can take bonus depreciation on those. Now, last year, that's 60%. The TCJA is sunsetting. Next year, it's only 40%. But I don't know what you guys think, but I think there's a good chance that that's going to get bumped back to 100%, right? And so if that gets bumped back to 100%, you can take bonus depreciation on the tangibles and get, 90 to 95% write-off. But there is a caveat for oil and gas. You can only take those tangibles on wells that are drilled and made capable of production in the same calendar year. So if a fund closes on the 31st, that's obviously not going to happen. But on that early fund, we can get into some wells that are being drilled throughout the balance of 2025 and get a higher deduction. So that'll be available. We'll walk through that. From an expectation standpoint, we tell people this is a passive income generator, right? You'll start to get your distributions from the cash flow of the wells. That typically starts, we set the expectation of the third quarter after the fund closes. The first 2 funds for us have been the second quarter. I tell people year 1 is kind of an allocation year. We're putting the money to work. It's like we're doing a commercial real estate building and we're building the apartment complex. Rent starts to come in, oil starts to get produced, and then the cash flow starts by the second or third quarter. First year is maybe a 5 to 10% distribution, but then we target a total return of capital to happen by somewhere between years 3 and 4. And so from there forward, it's just all return on top of that. And that's on a cash on cash basis. That does not include the tax benefits. So the way oil wells work is the cash flow comes on high and over time it declines. And so the years 2, 3, 4, and 5, you're going to get a lot of flush production and have, large distributions. So we're targeting a total return of cash on cash between years 3 and 4. At least that's how we underwrite.
Okay.
So that's the expectations. Yeah.
So in what you described too, so now I'm thinking as an advisor, if I have a client who has a couple $1 million IRA and they want to convert portions of it, would they then invest in one fund every year to get the bigger benefit in the early years of that particular fund? Because as you described, it's going to decline in the latter years.
Yeah, I mean that's a great strategy. I mean, if they have the liquidity to do that,
right,
and taking, another thing that I run into, by the way, and you're a CPA, so you know this, but like, someone will come and it's like, oh, I got a $2 million, IRA, you just want to convert it all in 1 year. Like,
no.
First off, do you have that kind of money to do that? And non-liquid funds, okay, I mean, good for you. But then there's things like excess business loss rules. There's AMT. There's a lot of things you need to think about before you just run and jump after one strategy.
Yes.
Which again, you need an advisor. So, and in that case, you probably need not just a financial advisor, but you need a really good accountant as well, or a tax advisor. And so, not that I'm doing a commercial for you guys, but I tell
thank
people
you, though.
have good advisors in place. And I prefer advisors to be in the middle, by the way.
Yeah, no, you're absolutely correct. You don't. Yeah. Jim and I have had this discussion before, and we do want to point out that what you're saying is 100% spot on. Oftentimes, people have this idea that they can do this, and maybe they do have the liquidity, but is that the most, even if they do, is that the most ideal approach? Probably not. It may be more beneficial that they spread it out, and don't put yourself into that highest tax bracket unnecessarily, because now you're paying the high marginal tax rate, and it wouldn't make sense. Now, of course, we may see something different, because you raised the fact that I guess in some of the depreciation that might change because of the sunsetting of the tax law back in 2017, the TCJA. But I think under the Trump administration, he not only wants to extend it, he wants to expand it. So I think we might see, now that they have control of both houses, we might see something differently. It may not. I mean, I'm leaning towards the fact that they more than likely will see something. Now, the bigger question is when. I'm not quite sure that we'll see something this year. I think more than likely, if anything comes to pass, they might extend that particular tax legislation, not allow it to
Yeah.
sunset. But I think then they might expand on it with a different tax legislation into the new year, meaning 2026.
Yeah. Well, that'll be interesting.
Yeah.
I don't know what your thoughts are on what that would be, but I certainly think there was bipartisan support for the bonus depreciation. So I think that part will probably come back, but it's politics, so who knows? But I think there's a good chance that they just extend the 2017 tax cuts.
Yeah, I think that's what's going to happen.
I agree.
So we are coming close to the end here, time-wise. So do we want to wrap up and give Steve a couple of bullet points that he would want to emphasize for us and our listeners?
Please.
Yeah, I mean, look, I think that oil and gas as an asset class is fantastic in and of itself, allocated appropriately. So the example we just gave, right? Just because you have $2 million offset a Roth conversion, do you really want to allocate $2 million to one asset class inside an alternative space? I don't know if that's a good strategy.
Probably not.
Probably not, unless you just have tons of money. But again, all of it has to be done inside of an overall picture. So again, have a good strategy, or have a good advisor helping you with that strategy. And I think from a oil and gas standpoint, the tax benefits are unbelievable. There's no doubt. There's very few investments. Maybe you guys know, I mean, I can only think of like short-term rentals, but you still have to qualify for material participation. For here, you literally can make the investment. It's a passive investment. You get a big tax write-off. So that can be used in a lot of different scenarios. Roth conversions is one of those. But make sure you understand what you're getting into. Make sure you understand what the expectations are. And I would say this for all private placements to your listeners, and you guys know this as well, is when you're looking at private placements, it's very important to understand the sponsor's background and how the sponsor makes money, especially how much money the sponsor makes up front. And if you feel like there's a misalignment there, or it's too hard to understand how they're making money, then I think that it's probably something you should consider passing on.
Yeah, it's not an ideal investment for our clients. Well, Steve, we want to thank you. This was so informative. It was great. We really appreciate you taking the time out to speak to Jim and I, and we look forward to working with you in the future with clients, and maybe perhaps having you back as a guest, later on in the year.
Well, it'll be interesting to see what the Trump administration does, so maybe we'll have some things to talk about.
Yes.
But I appreciate the invitation. It was fun, and anytime I would love to come back on and be a guest, and I appreciate it.
All right, Steve. Thanks
Enjoy
again.
your conference.
Yes.
Okay. Take care, guys.
Bye now.
Thank you for joining us on this episode of Enlightened Wealth Strategies. We hope you found today's discussion insightful and inspiring.
If you enjoyed this episode, don't forget to follow and subscribe to our podcast. You can find us on YouTube, Apple Podcast, Spotify, or your favorite podcast platform to stay updated on new episodes.
Your financial journey doesn't end here. Connect with us online for even more resources and exclusive content.
Until next time, remember, financial enlightenment is just an enlightened wealth strategy away. Investment advice is offered through Bell Point Asset Management, LLC, 500 Demont Ranch, Parkway Building 700, Unit 700, Reno, Nevada, 89521. Additional information about Bell Point Asset Management is available on the SEC's website at www.advisorinfo.sec.gov. It is important to read our disclosures available at this link, www.bellpointasset.com/disclosures. The information provided in this presentation is educational and limited to the dissemination of general information. This material is not intended to be a recommendation of any kind, investment, tax, or accounting advice. Does not constitute a solicitation to buy, sell, or hold a security or an investment strategy. Engage in any financial transaction and is not provided in a fiduciary capacity. The information provided does not take into account the specific objectives or circumstances of any particular investor or suggest any specific course of action. Investment decisions should be made based on an investor's objectives and circumstances and in consultation with his or her financial professionals. While the advisor uses reasonable efforts to obtain information from sources believed to be reliable, the advisor makes no representation that the information or opinions contained in this material are accurate, reliable, or complete. All information and opinions contained in this material are subject to change without notice. The views and opinions expressed are for informational and educational purposes only as of the date of the production or writing and may change without notice at any time based on numerous factors such as market or other conditions, legal and regulatory developments, additional risks and uncertainties, and may not come to pass. This material may contain forward-looking information that is not purely historical in nature. Securities offered through Fortune Financial Services, Inc., member FINRA and SIPC, Bellpoint Asset Management, LLC, and Fortune Financial Services, Inc. are not affiliated. Past performance is no guarantee of future results. Investing involves risks. Principal losses possible.